So this is going to be a rather quick lesson, but I want to go through how to pay yourself if you own an LLC, if you're a sole proprietor, if you are an S Corp or a C Corp. And again, if you're following along in the textbook, we are going to be starting off on page 59. Now, to pay yourself as an LLC, you have the option of owner's draws, which an LLC owner can take money out of the business as a quote-unquote draw. This means that the owner can withdraw money from the LLC's profits or cash reserves, so from the bank account. The owner's draw is not considered salary or wages and is not subject to payroll taxes. However, the owner may still have to pay self-employment taxes on the draw. Then you have a salary option, so LLC owners can pay themselves a salary as an employee of the company. This is the one I recommend. This is subject to payroll taxes and other employment taxes. The owner must also comply with state and federal employment laws such as minimum wages and overtime requirements. LLC owners can also receive a guaranteed payment for services they provide to the company. This is similar to a salary but is not subject to payroll taxes. However, the owner must still pay self-employment taxes on the payment. LLC owners can also receive a share of the company's profits, which is called a profit distribution. This is typically based on the owner's percentage of ownership in the company, and generally these disbursements are at the end of the tax year. So sole proprietors really only have one way of paying themselves, and that is when you make a sale, you keep the money. You are generally incurring all of the costs, and you're also, getting all of the profit. So a sole proprietorship is a type of business entity in which an individual owns and operates the business. It is the simplest form of a business structure and does not require any legal formalities to be established. As a sole proprietor, the individual is personally responsible for all of the business's debts and liabilities, and they have complete control over the management and operation of the business. The income from the business is reported on the owner's personal tax return, and there is no separate tax return required for the business entity. This type of business is often used by small businesses, consultants, and freelancers who operate their own business. Again, if you are an S corporation or if you're considering becoming an S corp, I recommend that you wait until you are making at least $40,000 to $50,000 a year. Now, there are certain S corp restrictions, so you can only have up to 100 shareholders. You have to be a domestic business entity. It has to be owned by a U.S. citizen or legal resident, and it's common stock only. So S corp owners have two ways to pay themselves. First is going to be salary. So business owners who work for the company as employees can receive a salary like any other employee. The salary must be reasonable and in line with the industry standards for similar positions. The business owner will receive a W-2 form from the company that shows their salary, and they will need to pay income taxes and Social Security and Medicare taxes on the salary. So if you are a plumber and the average plumber in your area makes $60,000 a year, you can pay yourself a reasonable accommodation to that, so you're not going to be a $7 million plumber if your business is making, millions of dollars, but, you're going to be close to that $60,000, maybe $100,000 range. Second form is going to be distribution, so business owners who are also shareholders in the company can receive distributions of the company's profits. These distributions are not subject to Social Security and Medicare taxes, and they are not subject to income taxes at the corporate level. However, they are subject to personal income tax at the shareholder level. So C corporations are typically used by larger companies that plan to raise capital, money by issuing stock or going public through an initial public offering or IPO. They're subject to, more complex tax rules and regulations than other business entities like the S Corp or LLC. But there are three ways a C Corp can pay themselves, and that's going to be salary. So the most common way for business owners to pay themselves as a C corporation is through a salary. The owner can set themselves up as an employee of the company and receive regular paychecks just like any other employee. The salary must be reasonable again and based on the work the owner performs for the business. If you're working 10 hours a week, you're not going to get paid a 40-hour-a-week or full-time salary. C corporations can also pay dividends to their shareholders, including the business owners. Dividends are a distribution of the company's profits, and they are taxed at a lower rate than regular income. However, not all profits are required to be paid out as dividends. This is a prime example of, the types of tax laws that exist. It was the rich, for the rich, by the rich. Business owners can also take out loans from the corporation, but they must be paid back with interest. While loans are not considered income, they can be a way for business owners to access the company's cash flow without taking a salary or paying taxes on dividends. That's a key one there if you're curious about how the rich stay rich. I want to take a second to explain what exactly a business pass-through is. So a business pass-through is a type of tax status for certain business entities such as sole proprietorships, partnerships, LLCs, and S corporations. With a pass-through business, the profits and losses of the business pass through the owner's personal tax returns, and the business itself does not pay federal income taxes. So instead of paying taxes at the business level, the owners report their share of the business's income or losses on their personal tax returns and pay taxes at their individual tax rate. This means that businesses' income is the only one that's taxed. So it's taxed just once at the individual level instead of being taxed twice at the corporate level and then again at the individual level. Pass-through businesses are attractive to small business owners because they often have lower tax rate than traditional corporations, which are subject to corporate tax income. However, the tax implications of pass-through businesses can be complex, and it's important to consult again with a tax professional to determine the business tax structure for your specific business. Now, it is worth noting that pass-through business income is subject to self-employment tax, which covers FICA, so Social Security and Medicare, for self-employed individuals. Additionally, some taxes may have different tax laws and regulations for pass-through businesses, so it's important to research and understand the tax implications in your state.